thank you all for dialing in. We have a high volume of people who have registered, and we will allow a moment for people to come into the room. Due to the large number of guests, we will not be taking questions from the audience and ask that you direct all questions after the call to your CBA contact. Alternatively, you can access more resources about the content discussed in today's call by visiting commbank.com.au/federal budget. I will now hand the call over to Chris Mclachlan, Executive General Manager, Global Markets at CBA. Please go ahead.
Thank you and good morning, everyone. Thanks for joining us for our federal budget webinar today. Last night, of course, Treasurer Jim Chalmers handed down the federal budget for 2025-26, which detailed the government's fiscal and economic strategy for the financial year ahead. Some would say it's the budget that perhaps no one on either side of politics wanted, given we're so close to an election. So it's a really peculiar budget to break down. And to help us do that, with the budget highlights and key announcements that we'll go through, I'm delighted to welcome Luke Yeaman, our new Chief Economist and Executive General Manager for Research, to the call today. Luke, welcome. A busy night of analysis for the team, and so I can tell that by the fact that I got an email from you, as many of our clients would have, at about 1:20 this morning. So big night as always. So look, why don't you give us a rundown, an overview perhaps of the budget strategy, your general impressions, and then we'll do some Q&A from there.
Thanks, Chris. It's great to be here, and good morning to everyone on the call. As you say, budget night's always a big night, but it's a good night for economists, and we enjoy the challenge. Look, in our budget preview, we said this was a really difficult budget for the government to frame. As you said, it wasn't clear we would have a budget until quite recently, and they had a difficult line to walk. There would have been a lot of pressure to want to support households and provide cost of living relief, but at the same time, the government wants to be seen as responsible economic managers, and they really don't want to do anything that could be seen to be putting upward pressure on inflation and causing the Reserve Bank to think twice about cutting interest rates. So that was the task they were set. And I think there's two ways to look at this budget in terms of how they've achieved that. If you just look at the near term, over the next couple of years, at the aggregate figures in the budget, the overall economic outlook and the overall fiscal outlook, there isn't too much to see. It's a fairly restrained budget in that sense. The deficits over the next 2 to 3 years return after 2 years of surpluses. The deficit this year will be around $27.6 billion, or around 1% of GDP. And the next year that widens to around $42.1 billion, up to 1.5% of GDP. But they aren't big changes from the numbers that were previously presented in the December MyEFO. Similarly, on the economic outlook, the budget paints a fairly positive story for the economy, with growth picking up and inflation continuing to moderate, and continued strength in the labour market. And that's quite consistent with our view here at CBA. So when you look at that, you say there's probably not too much to see here, and the government's done a reasonably good job of providing some support in terms of cost of living through tax cuts and a few other measures which I will discuss in more detail, without adding too much pressure into the system and causing any concerns on the inflationary front. However, there is another way to look at the budget, and if you step back and look at the longer term, the government has benefited in this budget quite a lot, to the tune of about $35 billion, through improvements in what are called economic parameters, which essentially means the money the government receives because of the overall movements in the economy. These aren't active policy decisions the government's taken. These are things that come in because the economy is performing better. So there's around $35 billion of improvements, tax receipts, and reductions in spending because of a stronger labour market and a stronger economy. The government had a choice what to do with that money. It could have saved it and put that towards budget repair and help to reduce the deficit and the debt. But instead, on the eve of election, not surprisingly, they chose to deliver further support to households, in particular through new tax cuts, which we can say a little more about as we go through the call. Also, greater support for healthcare and to extend energy bill rebates. That's essentially chewed up all of that upgrade to the budget position that's come through a stronger economy. And what that means is, as we go forward into the medium term, beyond 3 or 4 years, towards 10 years in the budget, we're seeing larger deficits, and we don't return to a balanced budget until the very end of that 10-year projection period in the budget estimates. And we're also seeing, as a result of that, higher debt overall, both gross and net debt over that 10-year period compared to the previous estimates in my EFO. And what we think that does is it creates some vulnerabilities in the budget. We know there are long-term structural pressures in the budget. This budget probably worsens those pressures and adds to the budget task in the longer term. And it also makes the budget more vulnerable to international shocks. That's a brief overview, but very happy to dive into some of that in more detail.
Yeah, great summary and way to sort of set the scene for how to interpret the budget. Perhaps, Luke, can you go through the sort of the major initiatives in the budget? Let's go through them. Obviously, the big surprise was the tax cuts announced yesterday. So why don't you just walk through, as you see it, the major initiatives, and we can unpack them from there.
Absolutely. Look, there's always one surprise in a budget, and the Treasurer did a good job of keeping the tax cuts under wraps until budget night. I think it did surprise most economists and the market that there were additional tax cuts in this budget. So the tax cuts themselves are targeting the lowest marginal tax rate for the bottom tax bracket and reducing that rate from around 16% to 14%, which would deliver a tax cut to an average wage earner, someone who earns around $100,000 a year in Australia, of around $536 when the tax cuts are fully implemented. The downside is that the tax cuts don't start straight away. They don't start until the 1st of July next year, and they're phased in over 2 years. The total cost of that tax package is around $17.1 billion over the next 5 years, and that's easily the largest spend in the budget overall. Although the fact that the tax cuts are delayed is one of those factors that's helping to take pressure off inflation in the near term and preventing this from being a stimulatory budget. The government had already flagged a number of other measures since my EFO in the first half of this year that would be included in the budget, and there are some quite large health initiatives, in particular around $8.4 billion to help lift bulk billing rates for GPs. The goal is to try and get to a point by 2030 where 9 out of 10 GP visits are bulk billed. So that's a very big new investment in the health system. And there are a few other key health initiatives to both bring down the price of medicines on the pharmaceutical benefits scheme and improve women's health outcomes as well, along with a few other smaller measures. Those two things together, the tax cuts at $17.1 billion and the changes to bulk billing and healthcare at around $8.4 billion, make up the vast majority of the new spending in this budget. As flagged by many before the budget, they've also chosen to extend the energy bill rebates that have been in place in this financial year. That's at a cost of $1.8 billion for all households in Australia and for eligible small businesses. They have not this time, however, chosen to extend it for the full 12 months. They're only extending those energy bill rebates for 6 months. There's a range of other measures in the budget, but I would say they're the big ones. They're the ones that stand out to me when I look at the budget overall.
Okay, so the surprise to me was, and perhaps the absence of a significant defence initiative. Should we expect more to come there? Perhaps a little bit of detail on what you see there on the defence front.
Yeah, there's been quite a lot of discussion and chatter around a possible acceleration of defence spending in the federal budget. It didn't really come through in a big way in the budget papers themselves, but I think if you look ahead, there is definitely going to be upward pressure on the defence budget over the coming years. There has been for some time, and we've seen a gradual step up in defence expenditure. It's moving back towards about 2.3% of GDP over time in the budget estimates. But with the large investments in the AUKUS pact with the US and the UK, and with the general push globally to increase countries' resilience and self-sustainability and national security, I think there is definitely a sense that we could see further announcements in that space rolled out either during the election campaign or in the first budget after the election campaign. Those pressures are going to continue to build, and I expect to see upward pressure in that area.
Yeah, so there's risk number one in the budget outlook, which is important. Perhaps the other thing to just look at, to detail the initiatives, we should just go over the macroeconomic assumptions in the budget, and just let's reconcile those against your and your team's views on the economy.
Yeah, certainly. As I said earlier, the budget paints a quite positive picture of the economy, and in general, it's closely aligned with our own view, especially over the next few years. the term that's used in the budget papers is that the economy has turned the corner. And so the Treasury and the government are seeing a brighter economy over the next year compared to where we've been over the last couple of years. You can see that in the growth forecasts. So GDP growth has been running at around 1.5% this year. The budget forecast growth to pick up to around 2.25% next year and then 2.5% the year after. And that's off the back of stronger consumer demand building as we start to see interest rate cuts flowing through and a reduction in those inflation and cost of living pressures on households. I think that's an important watch point, and we're interested to see how quickly that consumer sector does come back. But in general, we agree that there's going to be a steady pickup in GDP growth going forward.
Okay, so there's a good watch there. Yep.
On the inflation forecasts, the Treasury has become more confident, according to the budget papers, in seeing inflation continue to come down sustainably inside the Reserve Bank's target band. They've brought forward the time when they think that will happen by around 6 months compared to their previous estimates. And they're feeling more confident that some of the key pressure points in the inflation outlook, things like housing costs, rent costs, insurance costs and services, which have been keeping the inflation rate a little high, they're seeing positive signs that those pressures are reducing, and we're seeing some disinflation in key parts of the basket. So they're seeing inflation continue to fall into the target band. And on unemployment, one change that was notable in the budget was on the economic outlook, was that the Treasury had reduced their forecast peak in the unemployment rate from previously 4.5% to 4.25%. So we've seen a lot of strength in the labour market over the past few years, particularly over the last 6 to 12 months. And Treasury are essentially saying we think that the labour market doesn't need to weaken as much as we previously thought to keep inflation sustainably in the band and be consistent with a pickup in growth. So that's a bit of positive news on the labour market side. As I said, overall, we're very closely aligned with those budget forecasts. We have a similar view of the economy. We think we are going to see a strengthening this year. But as I said, keep a watch on the consumer to make sure that that progresses as we think.
All right, so it's relatively aligned, but some risks in there for people to think through. Perhaps just from a logistics point of view, I mean, we've got the opposition will come out with their budget reply, and I've already seen, I think Angus Taylor has said that he'd oppose some of the measures in the budget. So, what should we expect out of that? And my follow-on question for you, Luke, is, given we're going into an election, do we expect more to come that's not in this announcement overnight?
Sure. Look, I think up till now, the opposition has been very keen to avoid getting into a fight on big budget spending initiatives. They've tended to match the government on some of the key spending initiatives that have been rolled out so far. So, for example, in areas like health, the government made an announcement, the opposition quickly came in behind it and said we will match it and in fact beat it by a small amount. I think the tax cuts will be an interesting decision for the coalition to make. Do they match the tax cuts? Do they look to exceed and beat those tax cuts? My guess is they will probably look to match those tax cuts. I think it'll be hard to go to an election with one side delivering tax cuts and the other side not delivering it. And the coalition says regularly that they stand for lower, simpler and fairer taxes. So I think there's a good chance they'll match that. Other areas where the coalition may choose to make changes, they've been strong on their view that they're going to look for bigger savings from government and from the public sector to try and generate some efficiencies in the way that Canberra operates. That's one area that I think they will mark out in their opposition reply speech on Thursday. You mentioned defence, and I think there is a strong likelihood that the opposition will lay out further plans to invest a greater amount in both defence and national security capability. So I think that is always difficult to get away quickly, but I think they will look to make some commitments in that space probably over the longer term. Outside of that, let's wait and see where they go. But I think overall, the coalition is trying to minimise the space between it and the government, and then fight the election on a range of other issues. But let's see where they go.
Okay, some points of differentiation there for people to keep an eye on. I think really maybe just really interesting. Like we've seen the bond market be really sensitive to changes in outlook of funding. of governments, and we've seen it more acute in other countries where their debt to GDP ratios are much higher. So Europe, for instance, had a fairly volatile time of it of late after announcing step-ups in defence spending. Obviously, the US, we've seen huge volatility there. Whereas here, fiscally in a much better position as a starting point. But when you sort of start to build up this position for both the federal government and the states, it starts to get the bond market really paying attention. So, one of the assumptions in the budget is, I think, the 10-year bond rate around 4.3, or the average borrowing around 4.3, when the bond market's currently up around 4.5. So it'd be interesting to watch that. I guess the summary there is the government's got a bit of room to move here in terms of their overall health, but are sort of wedged in terms of not trying to sort of give too much to the market to react to ahead of an election period. Probably what people more often focus on is the RBA and the near-term outlook for rates. So how do you think the RBA will read the budget? And do you think they've sort of, the path that you were talking that they were walking, do you think they've managed that okay for now?
Yeah, it's a good question. I think if I come to the RBA first, on the RBA, our view is that this budget won't set off any alarm bells in the Reserve Bank. I don't think they will react strongly to any of the information contained in the budget. Equally, I don't think that the budget position that's been laid out gives the RBA more flexibility or room to move. Generally, it's a pretty steady as she goes budget. So I think other factors are going to continue to dominate the RBA decision, particularly how inflation tracks down over the next few months. That will be the key thing that our Reserve Bank is watching, along with the general strength in the economy and some of the international factors that we talked about earlier. So at this stage, as I say, I think the government has walked a pretty good line by not adding to the deficit overall. There's not a large fiscal expansion. What they have done is spent, as I said earlier, the potential upgrades that they could have otherwise banked. That would have potentially created a little more room for the Reserve Bank to have some more flexibility. But given that they spent it all, we come out basically even at the end of the day. So at this stage, we expect the Reserve Bank to largely look through the fiscal position and the impact on the economy. There are, as I said earlier, some changes to the electricity rebates. Those will, as they have in the past, affect the headline rate of inflation in a mechanical way. But the Reserve Bank has been very clear in the past and will continue to be very clear that they will look through those effects on the headline inflation rate, and they will continue to focus on those underlying measures of inflation, core inflation rate, trim mean, that we pay more attention to here as well. So I think at this stage, steady as she goes on the RBA. In terms of your point around bond markets and those global pressures, you're right, markets have certainly become more focused on debt and more focused on those long-term fiscal positions. You are definitely right to say that Australia's fiscal position relative to most other countries before and after this budget remains very strong, and there are other countries who are facing more acute challenges than we are. But you're also right to say that over recent years, particularly since COVID, there has been a very substantial ramp up in the overall level of government spending and the expectations of the community on what government can do for them, both at the Commonwealth and the state level. And healthcare is a really prime example of that. But we also talked about defence, but and also the National Disability Insurance Scheme continues to face cost pressures, although there are some downgrades to the spending projections in this budget. So there are a range of areas where there's pressure in the budget. That's going to continue to put up the pressure on those long-term fiscal projections. And I think there are also a couple of really important risks to this budget that I alluded to earlier. By essentially locking in permanent spending in this budget off the back of higher projections, of higher assumptions for growth, if those growth projections turn out to be too optimistic, if we don't see a pickup in wages that Treasury and the government expect to see over the next few years, if we see the global economy turn down a bit more sharply off the back of trade and tariff wars in the US, if we see that economy start to slow and not meet the expectations in this budget, the spending is already locked in, and that would mean that we're facing, in those circumstances, a deterioration in this fiscal position and higher debt and deficits, which markets would look at closely.
Yeah, and that last point is so important with the international outlook being so hard to read at the moment. So definitely, probably harder than at any time before to really help to look forward to those forecasts with confidence. And that's obviously a very difficult position for both the government and the RBA to navigate. So just on the RBA, we have CPI out later today. Can we just turn our attention to that data point, because that adds to the mix in the outlook?
Yeah, so we have the February CPI indicator, the monthly indicator, out today at 11:30. At this stage, we expect that outcome to be unchanged from the previous outcome in January, both for the headline rate at 2.5% through the year, but also importantly for the annual trimmed mean, which is that core measure of inflation that we think is most important for policy. We expect that to hold steady at around 2.8% through the year. I think we'll be watching closely to see what happens to market services and to housing inflation in that release. We do expect to see some continued disinflation, a disinflationary pulse in market services and in some of those measures of housing inflation. That's what we'll be looking for. But there are some other factors that are going to work on the other side to keep the overall rate steady, particularly those ongoing unwinds of the existing electricity rebates, including in the states, and some once-in-a-year price updates for education fees are also going to show up in this monthly release. So we expect to see an underlying disinflationary pulse in these figures, but with a few other temporary factors, you'll see the aggregate figure hold steady. We still think at this stage that we're looking for, in the quarter as a whole, in the March quarter, we're looking at a 0.6 outcome in the quarter for the trim mean CPI, which is a little below where the RBA currently sits, and we think that still paves the way for an interest rate cut in the May meeting of 25 basis points.
Righto, so still on track for people to look forward to some easing there to come. And of course, a lot of people look at that, the short-term rate, they look at the RBA, a lot of focus on it, of course, and then what you were talking before about the structural position and the bond market, really looking at that, that's important for those term borrowers, so businesses that look at their long-term rates and even sort of playing back into the affordability of deficits for the government. So it's all part of the puzzle. Look, you've done a pretty good job to sort of go through most of the key issues here and in summarising the budget overnight. Any closing comments or summary you want to make before we let everyone get on with their day?
Thanks, Chris. Look, there are a few closing comments. I think the way to think about this budget is it's for a pre-election budget. It's been relatively restrained, and there was a real risk. We had been tracking closely in our team the risk if there'd been a large spend in this budget that wasn't covered by other savings, then I think it could have made the Reserve Bank much more cautious about cutting interest rates in the way that we currently expect through the course of this year. So there was a real risk sitting at the heart of this budget of a big spending pre-election budget that could undermine that path to lower interest rates. The government has avoided that overall in the short term, but I think there is also underneath this a lost opportunity in some ways for the government off the back of a stronger economy, which is generating more revenue and helping make savings in the overall budget position. They could have used that opportunity to make some inroads into that longer term budget structural problem that's been in the country and at the core of the budget for a number of years and been growing steadily over time. I think there's a bit of a lost opportunity here not to have done some more, to bank a bit more of that upward revision to revenue and improvement in spending to improve debt over the longer term. They haven't done that, so that means that overall the budget position longer term remains a real challenge, and we think it also makes the budget more vulnerable to external shocks. So we'll be keeping a close eye on how things play out from here, but on the positive side, there are good signs that the economy is picking up, the labour market remains strong, and that inflation is coming down. So at this stage, we still expect to see 75 basis points of interest rate cuts over the course of the rest of this year.
Luke. So, as we said at the start, sort of a peculiar budget because you're going into the election, and as I really liked how you framed it up, that the government had a tricky path to walk between being responsible economic managers, cost of living, really focusing on that, and the RBA path, and obviously pre-election, they've anchored slightly towards that cost of living framing. And as you say, you just got to really look at that structural position on the way on the way forward. And for people who are borrowers in the economy, you've got to look at both the cash rate outlook, which you've forecast some cuts for, and then the bond rate market, which will really point to sort of a long-term interest rate outlook there as well. Really tricky internationally, as you say, to understand the external context. So therefore, people should be just looking at those macroeconomic assumptions closely to keep track of how we go. And of course, through the election, we're going to find out whether there's other additions to cater for as well. So there's quite a bit more than you would get in a typical annual budget cycle, I think. So look, great to have you. Welcome, and thank you for the summary that you've given everyone. So the next thing after CPI today, we look to the RBA and their announcement in May. Now, so for everyone on the call, we have a call scheduled on Wednesday, the 2nd of April, 9 a.m. So reach out to your CBA contact for an invite if you haven't already received that. Thanks, everyone, for joining us. Really important to help translate these events for each of you. So we really value you joining us for the discussion, and we look forward to catching up soon. Thanks very much.